We might have come across many stories inspiring us to be millionaires, but have you ever wondered how J.P. Morgan evolved into its present state? Do you know the man behind one of the world's biggest bankers? Success takes time, but working for it definitely is not so pleasing. Let us peek into the life of Jamie Dimon, once a banker, now the one who funds Wall Street. James Dimon is an American billionaire businessman and banker who has been the chairperson and chief executive officer of J.P. Morgan Chase since 2005. Dimon was formerly on the panel of directors at the New York Federal Reserve Bank. Dimon was comprised in Time Magazine's 2006, 2008, 2009, and 2011 indexes of the world's 100 most momentous individuals. Dimon's net worth is gauged at $1.8 billion. Dimon is among the few bank chief directors to evolve into a billionaire, especially because of his $485 million stake in J.P. Morgan Chase. He acquired a $23 million pay package for the financial year 2011, more than any different bank CEO in the U.S. Yet J.P. Morgan Chase lowered its payment to $11.5 million in 2012 following a string of contentious trading flops of $6 billion. Dimon accepted $29.5 million in the financial year 2017. Jamie was born in New York City. Dimon was among the three sons of Theodore and Themis Dimon, who held Greek origins. His parental grandfather was a Greek immigrant who labored as a banker in Lismur in Athens and transformed the maiden name from Papademetrio to Dimon. Supposedly, it was either because he was endeavoring to find work as a busboy, he conceded that people did not like to employ Greeks, or because he had fallen in love with a French lass and desired his name to sound French. Dimon has an elder brother, Peter, and a brotherly twin brother, Ted. Both his dad and grandfather were stockbrokers at Shearson. He attended the Browning School and majored in economics and psychology at Tufts University, where he graduated summa cum laude. At Tufts, Dimon penned an article on Shearson's mergers. His mom sent the documents to Sandy Weill, who employed Dimon to work at Shearson's during summer vacation doing budgets. After graduating, he toiled in administration consulting at Boston Consulting Group for 2 years before registering at Harvard Business School, along with peers Jeff Immelt, Stephen Mandel, Stephen Burke, and Seth Klarman. During the summer at Harvard, he toiled at Goldman Sachs. He graduated in 1982, achieving an MBA as a Baker Scholar. After graduating from Harvard Business School, Sandy Weill persuaded him to hang down Morgan Stanley, Goldman Sachs, and Lehman Brothers' proposals to join him as an associate at American Express. Although Weill could not deliver the same remuneration as the investment banks, he pledged to Dimon that he would have fun. Dimon's father, Theodore Dimon, toiled as an executive vice president at American Express. Sandy Weill departed American Express in 1985, and Dimon trailed him. The two then took over Commercial Credit, a customer finance organization from Control Data. 30 years of age, Dimon functioned as the chief financial officer, aiding in turning the company around. Though a string of amalgamators and investments, in 1998, Dimon and Weill built a substantial financial service conjunction, Citigroup. Dimon departed Citigroup in November 1998 after being requested to step down by Weill during a weekend executive retreat. In March 2000, Dimon became CEO of Bank One, the nation's fifth largest bank. When J.P. Morgan Chase bought Bank One in July 2004, Dimon became the combined company's president and chief operating officer. He was designated as the CEO of J.P. Morgan Chase on December 31, 2005, and on December 31, 2006, he was appointed the chairman and president. He was a Class A panel associate of the Federal Reserve Bank of New York in March 2008. Under Dimon's direction with the investments during this period, J.P. Morgan Chase has evolved into the leading U.S. bank in domestic assets under management, publicly traded stock value, and market capitalization value. In 2009, Dimon was deemed one of the top gun CEOs by Brendan Wood International, an advisory agent. On September 26, 2011, Dimon was entangled in a high-profile, agitated exchange with Mark Carney, the governor of Bank of Canada, in which Dimon stated conditions of the Basel III International Monetary Ordinance discriminate against U.S. banks and are anti-American. J.P. Morgan Chase initiated an emergency summit to register a loss of at least $2 billion in dealings that Dimon said were developed to evade the bank's prevalent credit risk on May 10, 2012. On January 24, 2014, it was declared that Dimon would acquire $20 million for his assignment in 2013, a year of record earnings and stock worth under Dimon's control, despite considerable flops that year due to disgraces and charges of fines. The honor was a 74% raise, which enclosed over $18 million in restricted stock. This is despite the $13 billion settlement with the U.S. government, the most extensive in history, for bad mortgages and traditions during the economic crisis. Following the announcement of Dimon's remuneration, Forbes reported that the bank declared under Mr. Dimon's stewardship, the business has strengthened its power, infrastructure, and operations, and fortified each of its key industries while concentrating on amplifying the company's administration abilities across all statuses. On October 28, 2008, as director of J.P. Chase, Dimon supervised the transfer of $25 billion in reserves from the United States Treasury Department to the bank under the Troubled Asset Relief Program. This was the fifth largest payment transferred under Section A of TARP to support the jittery asset linked to residential mortgages. It has been widely documented that J.P. Chase was in a considerably sounder monetary from the other banks. It did not require TARP funds but accepted them because the government did not desire to single out just the banks with capital problems. J.P. Chase broadcasted in February 2009 that it would employ its capital-based financial power to attain new trades. J.P. Chase was arguably the wholesomest of the 9 biggest U.S. banks and did not require to accept TARP funds. To facilitate the smaller banks with unsettled assets to receive this money, Treasury Secretary Henry Paulson allegedly forced the CEOs of the 9 gigantic banks to abide by TARP money on short notice. At 66, holding over the $3.8 trillion J.P. Morgan for 17 years, he's at the peak of his power in finance and politics. He has assembled a corporation that's Main Street's greatest lender and Wall Street's lending vendor. Its $48 billion in proceeds in 2021 was the loftiest in the annals of American banking. That year, the panel gave Dimon, the chairperson and CEO, an inducement package worth more than $50 million to remain until at least 2026. Since then, it's evident that the expanse of his term won't be sheer success lap. As Dimon bosses more in depth into what is traditionally the retirement epic, he yet has substantial challenges. Throughout 2022, investors have taken vexation by his weighty spending on technology assignments. They forsook the company's remuneration conventions. They took a slam as the bank stemmed from repurchasing its stakes due to a loftier financial needs. The stock is down 17% this year, barely more menacing than the S&P 500 Financials Index, but dreadful for J.P. Morgan, setting it to its greatest annual plunge since 2011. Meanwhile, Dimon keeps brushing off the question, who will oversee the house of Dimon after Dimon? When his aorta tore in early 2020, J.P. Morgan counted on its 2 co-presidents to temporarily share the CEO obligations. One of them, Gordon Smith, later retired, leaving the other, Daniel Pinto, there in case of an emergency. People close to Pinto, who turned 60 this week, says he isn't keen to become CEO and even predict he may retire before or at the same time as Dimon. Over the years, almost a dozen people seen as viable CEO prospects have departed. Indeed, Lake already interviewed to run Wells Fargo & Company when it was seeking a CEO in 2019, according to people familiar with that search. Once Dimon is done being CEO, the board has said the company may keep him on as chairman. The scene at the Morgan Library wasn't an aberration. Colleagues, rivals, and other observers say that the CEO, known for blunt assessments and market prescience, has seemed particularly negative about the world this year, showing that his would-be victory lap may cut through tough times. In October, he said a U.S. recession would arrive by mid-2023. He's even building a new Manhattan headquarters. The spree inflation have nudged expected expenses for this year up about 9% to $77 billion, more than the gross domestic products of most countries. Dimon has refused to back off, but he did decide it was time to confront critics of his vision. He announced an Investor Day, J.P. Morgan's first since before the COVID-19 pandemic. Colleagues urged him to set it for autumn, but Dimon wanted to quickly quell doubts about the bank's direction and push for May. It proved wise. A few days before he was supposed to go on stage, shareholders voted against the firm's executive compensation practices, a non-binding rebuke. With 5 hours of presentations by J.P. Morgan's top brass, Dimon turned things around, at least for a bit. Shares jumped the most in 1.5 years as executives spelled out plans behind the elevated spending, including when investments would pay off. Analysts lauded the level of detail and that, unlike many rivals, his firm's revenue growth puts it in position to support the spending that will keep it dominant. For J.P. Morgan employees, that will someday mean the bank's 60-story headquarters taking shape over Park Avenue, a building that some executive in Wall Street's upper... For J.P. Morgan's employees, that will someday mean the bank's 60-story headquarters taking shape over Park Avenue, a building that some executives in Wall Street's upper echelons joke will inevitably be named after Dimon. Wasn't that an inspiring story? who would be capable of replacing Dimon? Comment below whether the current executives will be able to lead the firm forward or not. Until then, adios.